changed a lot since we had you last. So what do you make of how this market looks today compared to where it looked a month ago?
Listen, by the way, I thought some of the commentary of the guests was really good. I mean, listen, I don't think the economy is. I think the economy's coming back, and I think Steph said it. The stimulus, when you actually do the math and think about how large it is, and we look at multipliers, et cetera, the economy's gonna come back. Are there stresses in the economy? Are there industries you want to be careful about? For sure. But listen, I think the equity market is reacting to what will be a better economic conditions. You know, would I say today that the market is cheap? No, I don't think the market is cheap. In fact, I think it's gotten fully valued. So we've been rotating out of some of the equity market in the last 2 or 3 days. I'm regretting what we did at the end of last week, but into more income-producing parts of the credit market, where you're further up the capital stack and a little bit safer with the equity valuations here.
That tells me that, you know, you look at where we are, and I don't know if nervous is the right word. Maybe it isn't. But I feel like you're assessing and wondering, you know, man, this has been really good, maybe too good. Let's rotate a little bit. Am I right?
That's right. Yeah, that's right. I mean, you know, you take the numbers. It's hard, guessing what earnings estimates are going to be next year. But you're trading at 21 times earnings. Listen, I think the economy is going to be better shape than most. I hear a lot of people talking about we're going to economic duress. I actually don't think that's right. I think Bryn described it right. You're seeing a very significant structural change in terms of what the new industrial sector looks like. And those companies are doing well. And generally, the economy is going to come back. But would I take some? And by the way, have I been taking some equity chips off the table? I have, rotating a bit more in a credit. I mean, these valuations are markets gotten pretty full, particularly in some of those names that we like quite a bit that are in that technology or that virtual space.
You have some provocative thoughts that I'm looking at here. I mean, number one, you don't think we're going to retest, which is interesting
Correct.
in and of itself, because, I know that we've moved so far away, it seems. We've had such a huge retracement that I think the consensus is starting to be that we're not going to retest, but also that the consumer is going to be a better than a lot of people think. And then maybe that's the most controversial thought. Based on what, Rick?
So I'd say a couple of things. First of all, when you actually take these stimulus numbers and you get into the multipliers, you think about there's certain sectors, and you talked about some of the companies where retail is starting to pick up. You know, we actually go through it, and you take the income haircut. By the way, we're going to get an unemployment report this week that's going to suggest about potentially 17% unemployment. We think that is going to peak. Hard to say there's a peak around that date or a couple of weeks after that. But then you're going to start to see that what is real transmission of that stimulus getting in, those checks getting out there, we think the consumer will be in pretty good shape. Like I say, where do you take the risk? I think you take it in those companies in technology. By the way, the housing market, we think, will be in decent shape. So I do think that's right. By the way, one of the strategies that we think makes a bunch of sense that I don't think the market's going to test the lows. But option volatility in the equity market is still really high. You can sell downside, you can sell puts, you can buy up, but you can sell also call options against some of your long equity positions that end up creating a really nice income benefit to your portfolio and gets you longer if the equity market trades down again.
You're speaking John Najarian's language. John, you want to comment on Rick's trade?
Well, that's why Rick runs $2 trillion, Scott, because he's exactly right. When those premiums are fat like that, especially if you're a willing buyer at different levels of the market, one of the smartest things, it always frustrates me, Scott, when we have somebody that doesn't have Rick's commitment on the show that says, oh, I like this particular stock, but I like it $10 lower. Well, if you're really committed to it, sell that put $10 lower, because then you would be really putting your money where your mouth is. Rick is doing just that. And so, Rick, I applaud you. I think you're exactly right.
Thanks.
And on a day like today, when the volatility is down 10%, you're reaping the rewards, my friend.
No, I think some of these names that have run up so much, you talked about some of the tech stocks, you can still sell 20% upsides, 15, 20% upsides and get paid, 40, 50 volatility level on those equities. Well, that's pretty attractive. They could keep going, but would you reduce your risk up 20% again from here? Yeah, I think so.
How about that, Bryn?
Exactly.
Yeah, absolutely. I think that's a great way for investors to engage in the market when volatility is high. Because I know a lot of our clients are like, how do we take advantage of volatility? And I think the options market, either selling puts or selling calls, lets clients tiptoe back into the market, own the names they want to own, and either sell upside protection or downside protection, to capture that premium, especially when yields are so low. Everyone would love to capture some of that premium that these options are giving you right now in certain companies.
Hey, Rick, is there any scenario in which you see rates rising from here to the point where you get concerned that the move could be bigger than some people think in a shorter period of time than they're prepared for?
That's a great question, Scott. I mean, the Federal Reserve, think about where we are in the unemployment rate, and we're going to come into 2021. The unemployment rate is still going to be sticky hot. We're still going to have a dynamic. Some of these furloughed workers are going to take a longer time to bring back. So the Fed has to keep rates down for a long time, maybe well into 2021. So it's pretty hard for interest rates to get away from. The only part, the long end of the yield curve, if people start to believe inflation is coming, by the way, we like buying inflation break-evens. If people start to believe inflation's picking up, could you have long end interest rates? Could you have the curve steepen out a bit? I could see that. But, in the interim, the Fed's going to buy what could be up to $200 billion a month, and they're going to absorb the Treasury supply. And the ECB is doing also mammoth amounts of buying. Hard to see rates really hurt the equity market for a period of time.
Do you think that the Fed and the move that the Fed has made over the last 6 weeks supersedes almost anything that could come our way from a negative standpoint, barring a monster shock of another one of some sort?
Yeah.
Right? That's why we're assessing. That's why we're having this conversation in the first place, right? About where the market is, how the market's had an ability to have a V bounce in the first place. And the reason why the NASDAQ is on the verge, if this continues, of going positive for the year.
So I'd say a couple of things. First of all, I don't think the Fed could do it unilaterally. I think it's this partnership between fiscal and monetary. That's really powerful. The Fed in and of itself is hard to do it. And by the way, it's not moving down interest rates. I would argue that interest rate evolution isn't really going to drive the economy. It's a fact, quite frankly, that they've really put in place 10, it depends on how you cut it, somewhere between 9 and 12 programs across things like high yield, things like the commercial mortgage market, the municipal market, the commercial paper market. What they've done is they've basically staved off a significant liquidation of assets. They've let the markets work again. They've improved the AAA part of the asset stack in so many asset classes. You can't get financing done if AAA assets are under pressure. So they've done a lot, and I think, could you do it without them? No, I don't think so. But I also don't think you could do it unilateral. I think you've got to do it with fiscal, and it's part of why I think it's going to work. Listen, they have to be. We're not out of the woods in the economy. I don't want to be Pollyannish. The economy's still got struggles, and it's not going to traditional V shape. But boy, the firepower that's come at it is pretty profound.
I mean, especially when you look at an area like high yield, right? I mean,
that's right.
The Fed. I don't. Saved, is that the right word? I mean, what the Fed did with buying high yield ETF was extraordinary, and it certainly took a ton of pressure off of that market.
Yeah, I think that's right. But the one thing I would say is, I hear this all the time. People say, I'm just gonna follow the Fed, that the Fed because the Fed's in high yield now, I could be in the high yield market. I actually don't think that's right. I think like you said, what they've done. If you get at the ETF market, if you get at the top of the CLO market, the AAA part of the CLO market, then you can allow the financing to take place. Then you can allow investors credit risk transfer to work. And by the way, I wouldn't buy high yield because the Fed's in there. And I think the Fed is going to be very tangentially attached to the high yield market. But what they're doing is allowing financing and risk transfer to take place, preventing liquidation, wholesale liquidation of assets. And that's powerful. But if anybody says, I'm going into high yield, I'm going into commercial mortgages, mezzanine debt because the Fed's in, I think they're going to potentially lose a lot of money there.
Do you have a problem with what the Fed did in terms of high yield in that ETF? I had a conversation, I don't know, a week ago at the most with Jeffrey Gundlach, who sort of wonders whether they overstepped their bounds, so to speak, by doing that. And that, they didn't have the authority to do it necessarily, but they did it anyway. And here we are. I mean, do you have a problem with it?
Yeah. I mean, I don't. I mean, listen, if the Fed starts buying loads of high yield and all of a sudden it's buying the airline market, it's buying hotels and it's buying energy, then I would have a problem
buying
with it.
stocks.
I think that point is fair. Right, buying stocks. So I think the ECB should do more equity investment because I've never moved that economy unless they do innovative technology in Europe. But yes, I think so. But to get at the top part of the capital stack, listen, this is a once in a, I would say, lifetime, longer than that, a duress that hit the system from a shock that nobody anticipated. So do you need to do some things that are out of the ordinary? I think so. And gosh, where the Fed is going to play, meaning the top part of the capital stack, AAA assets in CLO, ETFs and high yield. Is the Fed going to have real pressure as a result of it and real losses as a result of it? Listen, I don't really think so. By the way, I also think the concept of profit and loss for the Fed is different than other entities. So no, I think they've been innovative, and I think what the Fed, maybe it was a bit slow in the financial crisis of implementing. And you got to give this Fed credit. And not everything is going to work perfectly. But gosh, I think the innovation and being aggressive and being upfront, which means generally you don't have to do as much if you're out there in front of it. And that's why I think the fiscal and the monetary have been right to be aggressive up front, because you may not need to use the bazooka as aggressively down the road.
Yeah, well, they used a lot of bazookas. We don't know if they have any bazookas left. Lastly, before I let you go, leave our viewers with a thought about emerging markets, which I'm looking at the notes here, Rick, and you say there are parts that you like. A lot of people are running away from EM right now, and I know that our viewers have been interested in that area in the past and wondering where real opportunity still lies as this equity market has run so far and seemingly disjointed itself with the economy.
So Scott, you need a sharper and sharper scalpel to find the areas you feel good about in emerging markets as time goes on. Particularly, they don't have the resources, they don't have the monetary fiscal bandwidth that the developed markets do. Certainly, the U.S. does. But there's some parts of it. We've been buying recently some of the hard currency debt. Some of the dollar-denominated debt in some of the countries where we feel. Indonesia is one of them. We've been entering Mexico a bit more recently. Colombia. There's some places, but listen, it's not going to be a huge part of our allocation. And by the way, we're doing it in debt form, and we're doing it in hard currency, in dollar denominated. So the yields are pretty attractive in a world where you look at where yields are in things like municipals, mortgages, treasuries. Nothing is attractive. Yields in the better quality EM, which sometimes feels like a bit of an oxymoron when you say that, but in the better quality EM that you can get 4 to 6% yield. We are. I would say we've got one toe in the water and feel pretty safe about that. But yeah, I think EM is going to still be trickier generally. And as you said, equity. By the way, I think China is still an interesting place to invest. You got to keep it scaled given some of the political risk. But I think EM, you got to be careful where you go. But there are some opportunities. But you got to have a sharp scalpel, I should say.
Yeah, for sure. It's good to talk to you. Be well.
Thanks, guys.
Stay healthy.
Thanks,
we'll
sir.
talk to you soon. That's Rick Rieder.
Thanks for having me.
Joining us over at BlackRock, running $2 trillion.